Imagine this. A fire sweeps through your home, leaving nothing but ashes and memories. You think you're prepared because you have homeowners insurance, but then reality hits. Insurance doesn't cover everything. It takes too long to get the insurance fund. And rebuilding feels impossible. The Pacific Palisades Wildfires have shown how devastating this can be. But the truth is, it can happen to anybody. Let it be wildfires, electrical fires, or just an accident that happens in your home and burns it down. And here's what most homeowners don't realize. There's one financial move that can save you in case this disaster ever hits you and your family. And in today's video, I'm going to share with you what that financial move is. With that being said, let's jump into it. Now, before we dive into this financial tool, I want to talk about this from a high-level financial management perspective and where this fits in. In FitBucks, we break your financial management plan into 3 categories. The first one is day-to-day money. The second one is money for future you. And the third category is risk management. What we're going to talk about today is all about risk management, making sure that you have financial options just in case something happens to you in the future. Most people think that having homeowners insurance is enough. And then they say, even if it's not enough, I have equity in my house, so I could just take a loan. But the reality is twofold. First, homeowners insurance might not be enough. And 2, when your house burns down, the fair market value also goes to just being the land value. Long story short, oftentimes you can't get a loan. Now, that's the second time I said this financial word, fair market value. So let's explain this in plain English. Let's just say your home is worth $700,000. When you own a property, that $700,000 is broken into 2 values. There's a land value and what they call a home improvement value. When your home burns down, that home improvement value goes to 0. So it's just land and that's it. So if I own my house for $700,000 and it burns down and that land is only worth $250,000, I can no longer get a loan. I have no more equity in my house. So let's just say I owed like a $400,000 mortgage on the house and the land is only worth $250,000. I can't get another loan. I don't have any equity. And even if I get a construction loan, after I get the construction loan, if you add that to the mortgage, it might be upside down. So I might not be able to get a construction loan either. And the homeowner's insurance that I get might not be enough to fully rebuild the property. And that is why every homeowner that has equity in their house needs to know about this financial tool. Hey guys, real quick, if you're still watching this video, it's because you're getting value from it. We enjoy making these videos, and when you subscribe to the channel, it helps us grow, which allows us to keep making more and more videos. So if you get a chance, please hit the subscribe button. With that being said, let's jump back into the video. The financial tool you need to help mitigate risk is a home equity line of credit, or what's called a HELOC. Now, a HELOC is like a credit card, but better. It's backed by your house, therefore the interest rate's a lot lower. And it's better than a loan because if you don't need it, you don't need to draw against it, meaning you don't have to pay interest on it. You only pay interest once you actually take the money. So let's just say in that earlier example I gave you where my house is like $700,000 and I have a $400,000 mortgage. I could take a $200,000 line of credit and never use it. And then if my house burns down, I could take the $200,000 line of credit immediately, tell the bank to move it to my bank account, and they can't take it from me. I get to use it. So even though the value of the house is gone, I still have those funds available to me. Now, this might not put you in the best situation because you're still paying interest on it, but it gives you the flexibility to explore all your options to make sure that you can maximize the value in your house. Let it be rebuilding it or rebuilding it and selling it and getting max value for it. At the end of the day, having that HELOC allows you to avoid a quote unquote fire sale because you have no other options and you just have to get rid of the property. So at the end of the day, you don't want to wait to have something happen to your house. So those of you that have equity in your house, you need to learn more about HELOCs. And to do that, be sure to watch this video next.